Welcome to the deep dive. This is where we really get into the details, pulling out the key stuff just for you. And today we are diving headfirst into, well, the world of business finance. We're focusing on part 1 of Unit 3 in the IGCSE syllabus.
That's right. Specifically, Chapter 25, Sources of Finance.
And honestly, getting your head around this chapter it's fundamental, isn't it?
Absolutely non-negotiable. Think of it like the foundations of a house. You need this solid base to understand how businesses actually, work, how they get the cash.
The fuel.
Exactly, the fuel to run day to day, pay the bills, and importantly, fund those bigger plans, those expansions.
Without understanding these sources, everything else feels a bit abstract.
It really does. So our mission here is to dig into the details from the source material, break it down, and hopefully help you really lock in this knowledge.
Couldn't agree more. And just a quick note right at the start, if you're looking for more resources, maybe some extra materials on this or other topics, you can always check out www.igcisi-business.weebly.com.
Yeah, that's a great place for supplementary stuff. Worth a look.
Definitely. Okay, so let's start with the basics. Why do businesses actually need money? It sounds obvious, but breaking it down helps, right?
It really does. The source text highlights sort of 3 core reasons or phases. First, you need money just to start the business. That's your startup capital.
Before you even open the doors.
Precisely. Second, you need money just to keep operating day to day, keeping the lights on, paying staff, buying materials.
The ongoing costs.
Right. And third, if a business wants to grow, to get bigger or do new things, it needs finance for expansion.
Okay, that makes sense. Startup, keeping going and growing.
And that startup phase, well, you need cash before you make your first sale, so you need an injection of funds right away.
For things like, equipment, if you're a restaurant, cookers, fridges.
Exactly. The source mentions things like cookers, refrigerators, utensils, furniture, for a restaurant example, but also things like paying rent deposits, legal fees, maybe setting up a website, initial marketing. It all adds up.
And most entrepreneurs, they often have to risk their own money first, don't they?
They often do. Finding enough startup capital is a huge hurdle for many new businesses.
Then there's the day-to-day running. Even when you're making sales, the money doesn't always come in when you need it to pay the bills.
That's a critical point the source makes. You've got wages to pay, maybe weekly, raw materials to buy, perhaps needing payment up front or within 30 days, utility bills landing on the mat.
But your customers might take longer to pay you.
Exactly. There's often a mismatch, a gap between money going out and money coming in. And you need finance just to bridge that gap, to manage your working capital. That's often where short-term finance comes into play.
We'll definitely dig into that. And the third reason, expansion. Businesses that are doing well often want to get bigger.
It's the natural progression, often. But expansion isn't cheap. The source lists several goals. Maybe expanding capacity because orders are flooding in, developing new products, venturing into overseas markets, or diversifying into different areas.
And all of those require serious money. Building a new factory, a big marketing campaign for a new country.
Heavy expenditure, as the source puts it, needs significant funding.
So different needs, different timings. This leads nicely into the distinction the source makes between short-term and long-term finance.
Yes. Short-term finance is defined as money borrowed for 1 year or less.
Okay, short time frame.
Right. And it's mainly for those day-to-day running costs we just talked about. Paying wages, buying raw materials or components, covering expenses like electricity bills, managing that working capital cycle.
And it's called short-term because the expectation is you'll pay it back relatively quickly, within that year.
That's the idea. It's a temporary buffer, not for buying major assets.
Right, because that's where long-term finance comes in.
Exactly. The source defines long-term finance as money borrowed for more than 1 year. Or, interestingly, it includes capital provided by the owners, which might never be repaid.
Ah, okay. So it covers both borrowing for the long haul and the owner's own investment.
Yes, it's typically used for major purchases, things that last. Think machinery, buildings, vehicles. These are long-term assets.
Things that deliver value over several years. The source lists machinery, buildings, equipment, property, office furniture as examples.
Correct. You might also use it to repay other long-term debts or fund those big expansion projects we mentioned. And as you said, some long-term finance, like the initial owner's capital or money raised from selling shares, is permanent capital. It doesn't have a repayment date unless the business folds.
That's a really key difference, borrowing versus ownership capital.
A fundamental distinction.
Oh.
So businesses have these different needs, short-term, long-term, startup, expansion, and they need to pick the right source of finance for the job. And as the source emphasizes, they'll probably use a mix of different sources over time.
Which brings us neatly to the core of this chapter. Where does the money come from? The source splits this into two main camps, internal and external.
Right. Internal finance is money that's generated from inside the business itself. It's already there, in a way.
Like profits the business has made.
Exactly. Or maybe selling off something the business owns but doesn't need anymore. The Force points out this is usually an option only after a business is up and running and generating some income or has assets it can sell.
Makes sense. You need to be a business first to generate internal funds.
Whereas external finance is money that comes from outside the business.
Like getting a loan from a bank or finding investors.
Precisely. This is often the go-to for startups, as they haven't got any internal funds yet. But established businesses also rely heavily on external finance, especially for big investments where internal funds just aren't enough.
Okay, internal versus external. Let's dive into those internal sources first. The source lists three main ones: personal savings, retained profit, and selling assets.
Starting with personal savings. This is probably the most common one for entrepreneurs just kicking things off. It's the money the owner puts in from their own pocket.
Their own savings account, maybe? Or sometimes, like, selling their car.
Could be, yeah. The source mentions personal savings, maybe money borrowed from family and friends, which is sort of treated as personal in this context because it's not a formal external source yet, or selling personal belongings.
And the big advantage here must be that it's readily available, isn't it, if you have the savings?
It is. You don't need to fill out forms or convince a bank manager. It's your money. And crucially, the source highlights it's cheap.
Cheap? How so?
Because there are no charges, no interest payments like a bank loan, no dividends you have to promise like with shares. It's your own money, so the financial cost is essentially zero.
Ah, okay. No borrowing costs. That's huge for a startup. But what are the downsides?
Well, the main one is you might not have enough personal savings for everything the business needs. It's limited by your personal wealth.
Right. You might only have a few thousand saved, but need much more.
Exactly. And the other big one is risk. You're putting your own personal money directly on the line if the business fails.
You lose your savings. Your personal wealth takes the hit.
Absolutely. It's the maximum personal financial risk. So compared to external sources, it's free in terms of interest, but potentially very costly personally if things go wrong.
Okay, makes sense. What's the next internal source? Retained profit.
Right. Now, this one is definitely for businesses that are already established and, crucially, making a profit.
Retained profit.
Yep.
So profit the business has made but hasn't given back to the owners.
That's exactly it. Profit earned, but deliberately kept in the business instead of being paid out as dividends for companies or drawings for sole traders partnerships. It's reinvested.
So the owners could have taken it out, but they choose to leave it in to help the business.
Yes. And it's a really important source of finance for many established businesses, like personal savings. The source points out it's cheap.
Same reason, no interest or anything.
Pretty much. Is money that already belongs to the owners, so using it doesn't involve borrowing costs. Now, owners might expect that reinvestment to lead to higher future profits and dividends, but there's no immediate interest charge.
And it's flexible, I imagine. You can use it for various things.
Very flexible.
Yeah.
The source mentions it can be used for anything from boosting day-to-day cash flow to funding smaller expansions or buying new equipment. You can let it build up in a bank account over time.
So the advantages are it's cheap, it's flexible, and if the business is profitable, it's readily available.
Correct. But the disadvantages, well, if the business isn't very profitable, there won't be much retained profit to use.
Right. Can't retain what you haven't earned.
And even if there is profit, retaining it means less money is paid out to the owners now. If owners rely on that income or feel they deserve a return on their investment, they might get unhappy if too much is retained.
The potential conflict between reinvesting for growth and rewarding the owners.
It's a classic balancing act. But compared to, say, getting a loan, retained profit doesn't add debt. Compared to selling shares, it doesn't dilute ownership. It's clean finance, provided the owners agree.
Okay, and the third internal source, selling assets. This sounds quite drastic.
It can be, but often it's just practical. It means selling off things the business owns but doesn't actually need anymore to raise cash.
Like an old delivery van or a piece of machinery that's been replaced.
Exactly. The source gives examples like surplus machinery, land, or buildings. It also mentions that larger companies might sell off entire divisions or parts of their business that aren't core to their strategy anymore. There was that example of Tribal Group selling its Synergy software unit for over £20 million.
Wow. Okay, so it can raise significant sums, not just pocket money.
Absolutely. And there's a side benefit, the source notes. Selling unused assets also frees up the space they were occupying, or the resources tied up in managing them.
So the advantages: you get a lump sum of cash, you get rid of stuff you don't need, and you free up space or resources.
Pretty much. But the downsides, the most obvious one is, well, you don't have that asset anymore.
What if you suddenly need it again later?
That's the risk. You've lost its use value. Also, you might not get a great price for it, especially if you need the cash quickly. Selling specialized machinery isn't always easy.
Finding a buyer could take time, and they might haggle you down.
Definitely. So unlike borrowing, there's no debt created, but unlike retained profit, you're permanently giving up something the business owned.
Okay. So looking at those three internal sources: savings, retained profit, selling assets, what's the overall picture? Why might a business prefer these?
Generally, businesses often prefer internal sources if they're available. Why? Because, as we've seen, they tend to be cheaper. Often no interest or dividend costs directly associated with raising the funds.
And you're not answering to external lenders or new shareholders?
Exactly. More control, lower direct cost. But the big if is availability. Startups have no retained profit or maybe few assets to sell. Owner savings might be small. Struggling businesses won't have profits to retain.
So internal finance is great when you can get it, but often you just can't, or not enough.
Which naturally forces businesses to look outside, to external sources.
Right. Let's move on to those external sources then. Starting with the short-term ones, money from outside, usually repaid within a year. The source listed 4: bank overdraft, trade payables, credit cards, and short-term loans.
Let's kick off with the bank overdraft. Super common, this one.
This is where the bank lets you spend more money than you actually have in your account, right? Up to a certain limit.
Exactly.
Yeah.
Your account goes overdrawn into negative territory. The key thing is you only pay interest on the amount you're actually overdrawn by, and usually just for the time you're overdrawn.
So it's flexible. If you only need a bit extra for a few days, you just pay interest on that bit for those days.
That's the main appeal: flexibility. You dip into it when needed, and as soon as cash comes in, the overdraft reduces, and so does the interest charge.
Sounds convenient for smoothing out those cash flow bumps. What's the catch?
Well, a big one mentioned in the source is that the bank can technically ask for the overdraft to be repaid at any time. They can call it in.
Really? Just like that? That sounds pretty unstable.
It makes it potentially unpredictable if a business relies heavily on it. Also, the interest rates on overdrafts can be quite high compared to, say, a planned loan. You pay for that flexibility.
So pros: flexible, only pay interest on what you use, relatively easy to arrange if your bank trusts you. Cons: bank can demand repayment suddenly, interest rates can be high. Good for temporary gaps, maybe not for long-term reliance.
Well put. Next up, trade payables, also called trade credit.
This is the one where you buy from suppliers but pay them later, like in 30 or 60 days.
Precisely. Instead of cash on delivery, the supplier gives you a credit period. It's like a short-term, usually interest-free loan from your supplier.
How is it a source of finance? You still have to pay eventually.
True, but during that credit period, say 30 days, you have use of the goods, maybe you've even sold them, and you still have the cash you would have paid for them. You can use that cash for other things temporarily, so it improves your cash flow for that period.
Ah, okay. It
Yeah.
delays the cash outflow. And the source says it's usually cheap.
Often, yes. Because if you pay within the agreed time, there's usually no interest charged.
So advantages: interest-free if paid on time, easy to get from regular suppliers, helps short-term cash flow. What are the downsides?
Well, paying late can definitely damage your relationship with a supplier. They might stop offering credit or even stop supplying you.
That could be disastrous.
It could. Also, suppliers sometimes offer discounts if you pay early. By taking the full credit period, you miss out on those potential savings. That's an opportunity cost.
So it's a useful tool, but you need to manage it carefully and maintain good supplier relations. Don't push it too far.
Exactly. It's about balancing the cash flow benefit against relationship risks and potential lost discounts. Okay, third short-term source: credit cards.
Business credit cards, I guess similar to personal ones?
Pretty similar. They offer a convenient way to pay for things, especially smaller expenses. The source mentions executives using them for travel costs or small businesses buying supplies.
And they often have an interest-free period too, right?
Yes, the source notes may be around 56 days. So if you pay the balance off in full each month by the due date, you get that short period of credit for free.
Sounds good, but the sting in the tail
Is the interest rate if you don't clear the balance. Business credit card interest rates are notoriously high, often much higher than overdrafts or loans.
Ouch. So really only for convenience and very short-term borrowing that you can pay off quickly.
That's the sensible way to use them. Plus, the credit limits might not be high enough for significant purchases anyway.
Got it. Handy, but potentially very expensive if you carry a balance. What's the last short-term external one? Loan capital, short-term.
Right. This is different from an overdraft. It's a formal agreement with a bank or lender for a fixed sum of money to be repaid over a fixed period, less than a year in this case, usually with fixed installments.
So less flexible than an overdraft, but more structured.
Exactly. You borrow, say, £10,000 for 9 months, and you pay back a set amount plus interest each month.
What's the advantage of that compared to an overdraft?
Predictability. You know exactly what your repayments will be and when. This makes budgeting easier. The interest rate might also be lower than an overdraft rate, although you pay interest on the full amount from the start.
And the disadvantage?
Lack of flexibility.
Yeah.
You have to make those repayments on schedule, even if you have a slow month for cash flow. You can't just borrow a bit more if needed, like with an overdraft, unless you renegotiate.
So better for a specific, planned short-term need where you're confident about repayments, but not for fluctuating day-to-day cash management.
That's a good summary. So these short-term external sources, overdrafts, trade payables, credit cards, short-term loans, they're all about managing the immediate financial needs, the working capital. Speed, flexibility, sometimes low cost, but often with risks like high interest or instability if not handled well.
Definitely tools for the short run, not for funding the big stuff.
Which brings us to the long-term external sources. Money from outside for big projects or assets, repaid over more than a year, or maybe permanent capital.
And the source listed quite a few here. Mortgages, debentures, hire purchase, share capital, venture capital, and crowdfunding. Let's start with loan capital again, but the long-term version, specifically mortgages.
Right. A mortgage, as the source clearly states, is a long-term loan that is secured against property.
Secured is the key word there, meaning the property is collateral.
Absolutely. The business borrows money, usually buy property or land, and if it fails to meet the repayments, the lender, usually a bank, can take possession of that property and sell it to get their money back.
That sounds like serious security for the lender. Does that affect the terms?
It does. Because the lender's risk is lower, the source points out that mortgage interest rates are typically lower than for unsecured long-term loans.
So advantages. Allows businesses to buy essential long-term assets like buildings, potentially at a lower interest cost than other loans, and repayments are spread over many years, maybe 15, 20, 25 years.
Yes. Makes large purchases affordable over time. But the disadvantages.
Yeah.
You need to have valuable property to offer as security in the first place.
Or be buying it with the mortgage itself.
True. And the huge risk is losing that property if the business struggles financially. That could mean losing your factory or office. Plus, it's a very long-term commitment.
Essential for property acquisition, but comes with significant risk tied to that specific asset.
Yep.
Okay, what about debentures? Sounds a bit more corporate finance-y.
It is often used by larger companies, particularly public limited companies, PLCs. A debenture is basically a type of long-term loan certificate issued by a company.
So investors buy these certificates. Are they owners then?
No, and this is critical, as the source emphasizes. Debenture holders are creditors, not owners. They have lent money to the company.
Like bondholders.
Very similar concept, yes. They are entitled to a fixed rate of interest payment each year, regardless of profits, and they get their original investment back on a set future date, maturity date. They have no voting rights.
So fixed interest, repayment date, no say in running the company. What are the pros for the company issuing them?
Well, those fixed interest payments are predictable costs. Crucially, unlike selling shares, issuing debentures doesn't dilute the ownership or control of the existing shareholders. And companies can often raise very large sums of money this way.
Sounds good. Disadvantages.
That fixed interest must be paid, even if the company makes a loss. This can put a strain on finances during tough times. It increases the company's debt level or gearing.
And if the company goes bust, where do debenture holders stand?
As creditors, they rank higher than shareholders. They have a better chance of getting some or all of their money back from asset sales compared to the owners, who are last in line.
Okay, so it's debt finance, maintains control, predictable cost, but creates a mandatory payment obligation. Different risk-reward profile than shares. Next, hire purchase, HP.
We see this a lot for consumers buying cars, but businesses use it too, for things like equipment, vehicles, sometimes even smaller property items.
It's paying in installments, right?
Yes. Typically, the business makes an initial down payment, a deposit, and then pays the rest off in regular installments over an agreed period.
And the unique thing the source mentions is ownership.
Right. With HP, the business gets to use the asset straight away, but it doesn't legally own it until the very final payment is made.
So if they miss payments.
The finance company can take the asset back, repossess it. The source notes HP can be short or long-term.
What about the cost?
This is the main drawback highlighted. HP is usually more expensive than getting a comparable bank loan.
Why is that?
Higher perceived risk for the lender. The asset being financed, like a vehicle or machine, is the security, and these things can lose value quickly or get damaged. It's often less secure for the lender than a mortgage secured on property, so they charge higher interest to compensate.
Okay, so advantages. Get the asset now, pay later in installments, spreads the cost, might be easier to get than a loan for some assets. Disadvantages. More expensive than a loan, don't own it till the end, risk of repossession.
It's a specific tool for acquiring specific assets, trading off higher costs for payment convenience.
Right. Now for a really fundamental one, share capital.
Absolutely key for limited companies. This is finance raised by selling shares or ownership stakes in the company.
And the source calls this permanent capital. Why permanent?
Because, unlike loans or debentures, the money raised from selling shares doesn't generally have to be repaid by the company. It stays in the business for as long as the business exists. Investors get their money back by selling their shares to other investors, not from the company itself.
So the company gets the cash and doesn't have a deadline to pay it back. Both private LTD and public PLC companies use this.
They do, but in very different ways and scales. Private limited companies sell shares privately, often to people they know, family, friends, specific investors. They can't advertise shares to the general public.
So the amount they can raise is more limited.
Generally, yes.
Huh?
Public limited companies, PLCs, on the other hand, can offer their shares to the general public, usually via a listing on a stock exchange. This is called a stock market flotation, or IPO, initial public offering.
And that's how they can raise huge amounts of capital.
Fast sums, potentially. That's the main advantage of going public. But the source notes it's a complex and expensive process.
The source also mentioned a rights issue. What's that?
That's when an existing company wants to raise more share capital. Instead of selling to new investors, it offers new shares to its current shareholders first, often at a discounted price. It gives them the right to maintain their proportion of ownership.
Okay, so people buy shares. What do they hope to get?
Two main things. Dividends, which are a share of the company's profits paid out to owners, usually annually. And capital growth, meaning the value of their shares goes up over time so they can sell them for more than they paid.
But dividends aren't guaranteed, right? Unlike the venture interest.
Correct. Dividends depend on the company making enough profit and the directors deciding to pay some out rather than retaining it all. It's variable.
What's the big downside for the company, or rather, the original owners, when selling shares?
Loss or dilution of control. Every share sold is a piece of ownership given away. Sell too many, and the original founders might lose majority control and the ability to make key decisions. For PLCs, ownership is spread very widely.
Plus, paying dividends reduces the amount of profit you can retain for reinvestment.
Exactly. And as mentioned, the process for PLCs is costly. For LTDs, finding buyers privately can be hard.
So share capital, permanent funds, no repayment, no fixed interest, dividends vary, can raise huge sums, PLCs. BUT dilutes ownership control, dividends reduce retained profit, complex, costly, PLCs. Finding buyers can be tricky, LTDs. Fundamentally different from taking on debt.
A major strategic choice. Okay, next is venture capital, VC. This sounds specific.
It is. The source describes it as investment from specialist investors, often in new or early-stage businesses that have high growth potential.
So not usually for established, steady companies.
Less often. VCs look for the potential next big thing. These investors can be wealthy individuals, sometimes called angel investors or dedicated VC firms, sometimes backed by pension funds or insurance companies.
And they don't just lend money, do they?
No, critically, they take an equity stake. They buy shares and become part owners, often significant minority owners.
Why are they interested in risky startups?
Because the potential returns are massive if the business succeeds. They accept the high risk of failure in exchange for the possibility of huge profits. They often bring more than just cash to expertise, industry contacts, strategic guidance.
But they expect something in return for that expertise and risk.
Definitely. They usually want some level of control or influence, often a seat on the board, and they typically have an exit strategy. They plan to sell their shares, hopefully for a large profit, maybe after 5-7 years, perhaps when the company floats on the stock market or gets bought by a larger firm, so they're not usually in it for the very long term.
Not always. Their goal is often capital gain over medium term. The source notes this is high-risk finance for the investor, which is why it's often available to businesses that can't get traditional loans because they lack assets or a track record.
So, advantages for the business. Access to large funds, especially for risky ventures, valuable expertise and contacts. It's equity, so no fixed repayments. Disadvantages. Loss of significant ownership and control. VCs have high expectations for growth and return. Potential pressure for decisions favoring a quick exit. Finding the right VC partner is crucial.
A powerful source for the right kind of high-growth potential business, but it comes with strings attached regarding control.
Okay, last one on the long-term list, crowdfunding. This feels very modern.
It is relatively new. The source defines it as raising money from a large number of people, the crowd, usually through an online platform.
So lots of people chipping in small amounts.
Exactly. Individuals might invest as little as, say, £10 or £20 each. It bypasses traditional banks or large investors.
What do the crowd investors get back? Is it always shares?
Not necessarily. The source mentions different models. It could be a reward, like getting the first product produced. It could be interest on a loan, peer-to-peer lending, or it could be actual shares in the company, equity crowdfunding.
And the online platform acts as the marketplace.
Yes. The business puts its pitch online, explains its idea, how much it needs, what investors will get. Potential investors browse, assess the risk and reward, and decide whether to invest.
What are the advantages for the business?
Well, it opens up funding possibilities, especially for unusual or niche ideas that banks might not touch. It's also a great way to test the market. If lots of people are willing to invest, it suggests there's real interest in your product or idea.
And those investors might become your first customers or biggest fans.
Definitely. You can build a community. It can sometimes be faster than traditional routes, too.
Downsides.
You need a really compelling pitch to stand out online. There's often an all-or-nothing approach. If you don't reach your funding target by the deadline, you might get none of the pledged money.
Oh, wow. High pressure.
Yes. Plus, the platforms charge fees. And managing communications and expectations with potentially hundreds or thousands of small investors can be very time-consuming.
So, a democratic way to raise funds, great for validation and community building, but requires a strong public pitch and carries the risk of getting nothing if the target isn't met.
That covers the main external long-term sources pretty well. Quite a range of options there.
Definitely. We've gone through internal, external short-term, and external long-term. Now, does the size of the business make a difference to which of these sources they can actually use?
Oh, massively. The source makes this point clearly. A small local shop owner just doesn't have the same menu of options as a giant multinational company.
So, small businesses, sole traders, what are they typically limited to?
Often it's back to basics. Personal savings, maybe loans from family friends, and retained profit if they're established and making money.
What about long-term borrowing?
It can be tough. Maybe a small business loan if they have a solid plan and some security, or a mortgage if they own property. But accessing things like the stock market for shares or issuing debentures, that's generally out of reach. They're often seen as higher risk by big lenders.
Whereas large companies, especially PLCs,
they have the full toolkit available. They can issue shares to the public, issue debentures, negotiate large loans or overdrafts with banks, maybe use venture capital for new divisions, acquire other companies. Their size, assets, and track record give them access to a much wider range of finance.
And presumably, they can often get better terms, lower interest rates?
Exactly. The source mentions they often get debt finance at lower rates because lenders see them as less likely to default. Lower risk for the lender equals better terms for the borrower.
So size really matters in the world of finance. It dictates not just how much you need, but where you can realistically get it from and what it will cost you.
A crucial factor. Okay, we've covered a lot of ground there.
We really have. Definitions, pros, cons, comparisons. How about we try a quick quiz to consolidate some of this? The source had some multiple choice questions at the end. Ready?
Sounds good. Let's test that recall. Fire away.
Okay, listeners, get ready to. Question 1. Which of these sources of finance is internal? Is it A, retained profit, B, mortgage, C, venture capital, or D, crowdfunding?
Internal. Think inside the business.
The answer is...
It's A, retained profit.
Correct. Retained profit is generated by the business. Mortgage, VC, and crowdfunding all involve getting money from outside sources. They're external.
Okay, good start. Question 2. Which of these is a short-term source of finance? A, mortgage, B, share capital, C, venture capital, or D, bank overdraft?
Short term. Less than a year. Managing day-to-day stuff.
Think flexibility for cash flow. The answer has to be D, bank overdraft.
Spot on. Mortgages are long-term property. Share capital is permanent. Venture capital is usually long-term equity investment. Overdrafts are classic short-term tools.
All right, question 3. Trade payables is a suitable source of finance to fund the purchase of what? A, a delivery vehicle, B, inventory, C, property, or D, direct labor.
Trade payables. Buying from suppliers, paying later. What do you typically buy from suppliers on credit?
It's B, inventories.
Exactly. You buy your stock or raw materials, inventories, from suppliers on trade credit. Vehicles and property are long-term assets needing different finance. Labor needs paying with cash, possibly via wages funded by cash flow or an overdraft.
Last one. Question 4. A rights issue involves the sale of what? A, fixed assets, B, new shares on the stock market, C, new shares to existing shareholders, or D, part of the business.
Remember we talked about raising more share capital and a specific method.
The answer is C, new shares to existing shareholders.
Perfect. That's the definition. It gives existing owners the right to buy new shares, usually at a discount, to maintain their stake. Selling fixed assets is option A. Selling shares on the stock market to the public is B. Selling part of the business is D.
Nice. Those questions really pull together some of the key distinctions.
They do, don't they? Well, that feels like a pretty comprehensive deep dive into Chapter 25, Sources of Finance. We've looked at why businesses need funds, startup, operations, expansion, distinguish short-term and long-term needs. Crucially, split sources into internal and external.
And we went through the specifics: personal savings, retained profit, selling assets internally. Then externally, the short-term options like overdrafts and trade credit, and the long-term ones like loans, mortgages, debentures, hire purchase, share capital, VC, and crowdfunding, including the all-important pros and cons for each.
And wrapped up by considering how a business's size impacts its financing options.
A lot to take in, but absolutely crucial for understanding business.
Definitely. So, as we finish up, here's a little something for you to think about, going beyond just the definitions. Considering all these sources, the risks, the costs, the control issues, if you were starting a small business today, which one source of finance would feel most attractive to you personally and why? And conversely, which one would make you the most nervous to rely on?
Ooh, that's a good one. Puts it into a personal context. Thinking about your own risk appetite and what you value most. Control, low cost, flexibility.
Exactly, food for thought. Okay, that brings us to the end of this deep dive into Chapter 25 of Unit 3 Business Finance. And remember, if you want more resources or need to revisit any concepts, head over to www.igca-business.weebly.com.
Thanks for tuning in and exploring these financial foundations with us.
Yeah, thanks for diving deep with us.